Hello, in this video we're going to talk about the short-run aggregate supply curve. Short-run aggregate supply curve shows the total quantity supplied of all goods and services, including real GDP, that firms want to sell at different price levels. The short-run aggregate supply curve slopes upward, has a positive slope, so as the price level goes up, the quantity supplied of real GDP increases. And we want to ask, why does the short and aggregate supply curve slope upwards? So here are three explanations. The first one is the sticky wage theory. Wages are sticky in the short run and don't immediately change to reflect underlying economic conditions. Labor union contracts prevent wages from changing from what's written in the contract, so that's one reason for sticky wages, are contracts. Social norms. Most workers' wages are updated very infrequently, maybe once or twice a year. So social norms will put in place some stickiness in wages. I should also point out that wages may be especially sticky downwards. Cutting wages may create hostility and bad morale among workers, something firms' owners might want to avoid. So wages are sticky in the short run. So the sticky wage theory indicates that if the price level unexpectedly rises, firms receive higher prices for their output but pay its workers the same nominal wage. Remember that the real wage, the wage adjusted for purchasing power, is just a nominal wage divided by the price level. So a rising price level, if this thing in the denominator is getting bigger, it means overall the real wage is getting smaller. So a rising price level reduces real wages when nominal wages are sticky, which reduces real costs of production. Firms will find that the profits are rising. They'll find it more profitable to hire workers, so firms will hire more workers and produce more output. And that's what we're looking for here, is this positive relationship. So an unexpected increase in the price level results in firms bringing more output to the market. So again, overall, this will cause profits to rise and the quantity supplied of real GDP to increase. So the short-run aggregate supply curve slopes upward. This idea of sticky wages holds logically in reverse. If the price level were to unexpectedly fall, firms are going to receive lower prices for their output but pay its workers the same nominal wage. Again, the real wage is the nominal wage divided by the price level. So a falling price level will increase the real wage. So if this thing in the denominator, the price level is getting smaller, real wages go up. And in that case, the real cost of production will rise and firms will use fewer workers and produce less output. So overall, this will cause profits to fall from these rising real costs, and the quantity supplied of real GDP will decrease. So the short and aggregate supply curve again slopes upwards. We get this positive relationship. Decrease in the price level that is unexpected will lead to a decrease in the quantity supplied of real GDP. So in summary, nominal wages are based on the expected price level. When the price level unexpectedly rises, real wages will decrease and cause a firm to produce more output. Let's get into the second explanation or theory for an upward sloping short and aggregate supply curve, and this is the sticky price theory. This argues that some firms will not change the price of its products when the price level unexpectedly changes because of menu costs. Firms may want to delay incurring the menu cost. What are menu costs? The costs associated with a firm changing the prices of its products, such as printing new price tags, catalogs, informing customers of the price changes, etc. So an unexpected increase in the price level will cause some firms to see a large increase in sales because these firms delayed increasing their prices. Their low prices will be attractive to customers, leading to rising sales and increasing the quantity supplied of real GDP. This will hold logically in reverse. An unexpected decrease in the price level will cause some firms to see a large decrease in sales because these firms delayed decreasing their prices. Their high prices will not be attractive to customers, leading to falling sales and decreasing the quantity supplied of real GDP. The third explanation for a upward sloping short and aggregate supply curve is sometimes called the misperceptions theory. An unexpected increase in the price level causes firms to mistakenly believe that it's more profitable to produce because it sells its good at a higher price, causing the quantity supplied of real GDP to increase. The firm doesn't realize that all prices are rising and its relative price of its product is really unchanged. An unexpected decrease in the price level causes some firms to mistakenly believe that it is less profitable to produce because it sells its good at a lower price, causing the quantity supplied of real GDP to decrease. The firm doesn't realize that all prices, input prices, and so on are also falling, and its relative price of its product is really unchanged. A similar example here, say a fisherman may see the price of salmon rising and think it is more profitable to fish and expand its output, but it doesn't notice that the price of everything else is also rising in the economy. So it's really this fisherman is really no better off or worse off. Workers could also be fooled by a rising price level. The rising price level may cause nominal wages to go up, and workers might think that their real wages are increasing, but they're really not. So more people enter the labor market, expanding output. Workers don't realize that all prices in the economy are rising. The aggregate supply can be expressed in an equation. The quantity of output supplied equals the natural rate of output or full employment output or potential real GDP plus alpha multiplied by the actual price level minus the expected price level. Alpha is just a number showing how deviations from the expected price level to actual price level affect output. If the actual price level is greater than the expected price level, so if the actual price level here in parentheses exceeds the expected price level, the actual quantity of output will exceed the natural rate of output. On the other hand, if the actual price level falls below the expected price level, the actual quantity of output will be less than the natural rate of output. A numerical example. Let's say that the natural rate of output is $2 trillion and alpha equals 0.1. If the actual price level is 110, but people expected the price level to be 100, what is the quantity of output supplied? The quantity of output supplied will be $2.1 trillion. 2 plus 0.1 times 10, or $2.1 trillion. So actual output will exceed the natural rate of output anytime the actual price level exceeds the expected price level. And again, we went through 3 theoretical explanations for this. Sticky wages, price level turns out higher than expected, with nominal wages being sticky, real wages will fall. Profits go up, firms produce more. We talked about menu costs. Actual price level turns out to be greater than expected. Some firms don't increase their prices initially. These firms will sell a lot of output at these artificially low prices. And then we talked about the misperceptions theory. All right, let's move on. Let's talk about factors that shift the short-run aggregate supply curve. Anything that shifts the long-run aggregate supply curve, more labor, more capital, more human capital, natural resource discoveries, technological advances, technological innovations, all of these things shift the long-run aggregate supply. They will also shift the short-run aggregate supply curve. Changes in cost of production will change the short and aggregate supply curve, causing the shift. So anything that increases the cost of production, higher wages, input prices, oil prices, regulatory costs, these will decrease short and aggregate supply, shifting the curve left. Anything that decreases the cost of production, just the opposite. This will lead to the short and aggregate supply curve shifting to the right. Let me also mention expected future prices. If workers and firms expect higher future prices, wages and input prices will rise and increase the cost of production. decreasing the short and aggregate supply curve. If workers and firms expect lower future prices, wages and input prices will fall as they get bid down, and this will decrease the cost of production, decreasing the short and aggregate supply curve. So just looking at a decrease in short and aggregate supply curve here, the curve shifts to the left. Shocks to the short and aggregate supply curve, such as this one, lead to economic fluctuations. So a decrease in the short and aggregate supply curve may cause recession, falling real GDP, rising unemployment. Stagflation is a decrease in the short and aggregate supply curve that causes real GDP to fall and the price level to rise, or inflation. All right, I'm going to stop here. I hope you found this video helpful.